The U.S. housing market is entering one of its most unpredictable years in recent history, and many real estate experts believe 2026 could be a turning point. For the past several years, home prices have climbed at a pace that simply wasn't sustainable. But now the signals are getting clearer. The pressure is building, the cracks are forming, and a correction may finally be on the way. Why is this happening? First, mortgage rates have stayed higher for longer than many buyers expected. Even small increases in borrowing costs can push thousands of potential homeowners out of the market. That shrinking pool of buyers creates slower demand, and when demand slows, prices follow. Second, non-mortgage costs have become a major burden. In many cities, homeowners are facing rising insurance premiums, higher property taxes, and bigger maintenance expenses. Reports from multiple real estate analysts, including sources like Housing Info and Norada Real Estate, show that these added costs are now one of the biggest reasons buyers are backing out. When the cost of simply owning a home becomes too heavy, markets start to weaken. Third, overbuilding has quietly become a major problem, especially in fast-growing Sunbelt areas. During the pandemic boom, builders rushed to meet demand, but by 2024 and 2025, that demand cooled, leaving many cities with more homes than buyers. Oversupply is one of the strongest early warning signs of a correction. And finally, there's bubble risk. Some metros saw price growth far beyond what local incomes could support. When prices rise too fast, without strong local fundamentals, they eventually snap back to reality. So how did we pick the cities on this list? We analyzed market forecasts, risk reports, and trend indicators from reputable housing researchers. We looked at supply levels, demand shifts, local economic signals, insurance pressures, affordability problems, and expert warnings. In this video, we're breaking down the 10 U.S. cities real estate experts believe carry the highest risk in 2026. These are markets showing clear stress, places where buyers need to be extra cautious. Don't forget to hit subscribe so you never miss a new video. Let's start with city number 10. Tucson, Arizona enters this list at number 10, and real estate experts say it's a market buyers need to watch closely in 2026. According to analysis shared by Norada Real Estate, Tucson has been flagged as one of the higher risk markets in the Southwest, mainly because the forces that pushed it up during the pandemic are now fading fast. During the pandemic boom, Tucson became a magnet for people leaving bigger and more expensive cities. Builders saw the demand and moved quickly, adding large amounts of new housing to the market. But by late 2023 and into 2024, demand began to soften. Reports from cash flow rentals show that oversupply is now one of Tucson's biggest challenges. There are simply more homes available than buyers ready to commit, and that imbalance puts downward pressure on prices. This oversupply connects to a bigger trend, the Sun Belt slowdown. For years, cities across Arizona, Texas, and Florida grew at a pace that looked unstoppable, but experts now warn that some of those gains were inflated by temporary demand. Remote workers, short-term investors, and people fleeing high-cost states. As those trends settle, cities like Tucson are finding themselves with more housing inventory than the market can comfortably absorb. On top of that, Tucson's economic growth has cooled. Job expansion has been slower compared to other Arizona metros, and many local employers haven't recovered to the strength they had. Pre-pandemic, a softer economy usually means fewer qualified buyers and more cautious lenders, which can slow the market even further. So what do experts expect for 2026? Many analysts believe Tucson could see price softening, longer selling times, and more negotiation power shifting to buyers. Real estate reports suggest that buyers should approach Tucson with caution until supply and demand move back into balance. Tucson isn't crashing, but the warning signs are too strong to ignore, and that's why it ranks number 10 on this list. At number 9, we have Albuquerque, New Mexico, a market that real estate experts say is showing early signs of stress heading into 2026. Norada Real Estate lists Albuquerque as one of the top risk metros, and the reason is simple. Small markets can move fast in either direction, and right now the momentum isn't looking great. During the post-pandemic period, Albuquerque saw one of its strongest spikes in home prices in years. Remote workers moved in, investors bought aggressively and inventory shrank. But experts warn that the gains came too quickly for a market its size. According to Narada, the rapid rise has now created instability, making Albuquerque more exposed to shifts in interest rates and buyer confidence. One of the biggest concerns is market volatility. Albuquerque doesn't have the population growth or economic expansion that larger cities rely on to stabilize prices, so when demand cools, even a little, the impact shows up fast. And that's exactly what is happening now. Recent market data shows softening across key indicators, fewer bidding wars, more price cuts, and homes sitting longer before selling. Inventory is also creeping up. For a smaller metro, even a moderate increase in supply can tilt the market. Analysts note that Albuquerque now has more available homes than active buyers, which usually signals downward pressure on prices. The buyer pull that the city enjoyed from 2020 to 2022 has weakened, especially as higher mortgage rates push would-be homeowners back to renting. Looking ahead to 2026, many experts believe Albuquerque could face deeper corrections compared to other Western metros. The mix of slower job growth, rising supply, and fading investor interest puts the city in a vulnerable position. If national conditions tighten further, smaller markets like Albuquerque often feel the impact first. This doesn't mean a crash is guaranteed, but the warning signs are strong enough for experts to urge caution. That's why Albuquerque lands at number 9 on this list. Coming in at number 8 is Tampa, Florida, a market that many experts say could be heading for a rougher stretch in 2026. Go Banking Rates has already highlighted Tampa as one of the major U.S. cities where home prices may slide noticeably, and several market factors are lining up to support that warning. First, Tampa is dealing with a sharp increase in housing inventory. During the pandemic boom, homes were selling within days, but now more properties are hitting the market, and they're staying there longer. Reports from cash flow rentals point to a clear shift. Fewer buyers, less urgency, and more sellers adjusting prices. This rising supply is one of the biggest red flags for any housing market. And in Tampa, it's happening faster than many expected. But the pressure isn't just coming from supply and demand. One of Tampa's biggest problems is the cost of living outside the mortgage payment. Home insurance rates in Florida have climbed dramatically over the last few years because of storm losses and insurer withdrawals. Property taxes have also continued to increase as home values surged, and many new homeowners are now feeling that weight. According to real estate analysts, these higher non-mortgage costs are pushing more buyers out of the market entirely. On top of that, climate-related concerns, like stronger storms and rising flood insurance requirements, are making some buyers think twice. Experts at Narada Real Estate warn that in coastal metros like Tampa, climate risk is becoming a real financial factor, not just a talking point. So what could 2026 look like? If demand keeps weakening and inventory continues to rise, Tampa could face price corrections, especially in neighborhoods that saw big speculative jumps from 2020 to 2022. Buyers may gain more power, but sellers might struggle to move homes unless they cut prices or offer incentives. Tampa isn't collapsing, but the combination of rising costs, slowing demand, and growing supply puts it firmly on the caution list. At number 7, we land in Winter Haven, Florida, a city that exploded during the pandemic boom and is now flashing several warning lights. Narada Real Estate lists Winter Haven as a high-risk market for 2026, and the reasons are stacking up fast. During the pandemic years, Winter Haven saw rapid appreciation, with homes jumping in price as buyers poured into Central Florida looking for more space and lower costs. According to cash flow rentals, this surge wasn't gradual. It was a full-on spike. Investors, flippers, and out-of-state buyers rushed in, pushing prices far beyond the city's normal pace. For a while, it looked like Winter Haven had discovered rocket fuel. But rocket fuel burns out. Now we're seeing the early stages of a correction. Homes are taking longer to sell. Price cuts are becoming more common, and analysts say the slowdown is especially sharp in neighborhoods where investor activity was the strongest. Once short-term demand fades, markets like Winter Haven often struggle to support those inflated values. A big vulnerability here is the investor mix. Winter Haven became a magnet for speculators and short-term rental hosts. That type of buyer is fast to enter a market when prices rise, and even faster to exit when things get shaky. If 2026 brings more uncertainty, these investors could pull out, flooding the market with extra inventory. So what happens if the downturn continues? For sellers, it could mean more price reductions and homes sitting on the market far longer than expected. Some may even end up underwater if they bought at peak prices. For buyers, it's a double-edged sword. Yes, there may be better deals ahead, but falling values can also mean lenders get stricter, and neighborhoods with heavy investor activity can feel unstable during a correction. Winter Haven isn't falling apart, but the boom-to-bust pattern is hard to ignore. Experts agree, this is a market to approach with caution in 2026. Coming in at number 6 is San Antonio, Texas, a market that many experts say could cool much faster than people expect. Recent forecasts highlighted by Yahoo Finance point to San Antonio as a city where supply is starting to outrun demand, and that imbalance is one of the strongest early signs of a correction. Here's what's happening on the ground. San Antonio has seen a surge of new home construction over the past few years. Builders were racing to keep up with the massive population growth across Texas, and for a while it made sense. But now the pace has shifted. While construction stayed high, buyer demand has softened, especially as mortgage rates climbed and affordability took a hit. This mismatch is already showing up in the data. Homes are taking longer to sell, price cuts are becoming normal, and days on market numbers are rising across multiple neighborhoods. These aren't small changes. They're signs that the market is cooling from the inside out. Unlike Austin or Dallas, San Antonio used to be known for stability and affordability. But that's exactly why the rising supply is such a big deal. When a market with steady, predictable growth suddenly builds far more homes than buyers are ready for, the result is downward pressure on prices. Experts say the real risk comes if this trend continues into late 2026. If the inventory keeps growing and demand stays slow, San Antonio could face significant price corrections, especially in the outer suburbs where most of the new construction is located. First-time buyers may pull back even more, investors may pause, and sellers may find themselves competing harder than ever. This doesn't mean the city is collapsing, far from it, but it does mean the once safe and affordable San Antonio housing market may no longer offer the same protection it used to. If you're planning to buy or invest here in 2026, the message from analysts is clear. Proceed carefully. Now let's move to city number 5. Another Texas hotspot facing even bigger challenges. At number 5, we have Austin, Texas, a city that went from one of the hottest markets in America to one of the most at risk for a correction in 2026. Go Banking Rates has already flagged Austin as a potential trouble spot, and the warning signs are loud. The biggest issue? Overbuilding. Austin went through a massive construction boom during and after the pandemic. Developers rushed to meet the demand from tech workers, remote employees, and investors. Huge rental complexes, luxury apartments, and new suburban communities were built at a record pace. For a while, it looked unstoppable. But then the market shifted. Across multiple Reddit housing forums, renters and landlords have been talking about big rent drops happening throughout the city. Some renters say their monthly payments were cut by hundreds of dollars. Others report landlords offering 2 to 3 months of free rent, cash bonuses, and other concessions just to keep units filled. That only happens when there's one problem: too many units and not enough people to fill them. With apartments sitting vacant and rent prices falling, investors are starting to feel the pressure. Lower rents mean lower returns, and lower returns usually lead to falling property values. This is especially risky for owners who bought at peak prices in 2021 or 2022, when Austin was being promoted as the next Silicon Valley. Affordability is also becoming a major concern. Even with rents dropping, Austin is still expensive compared to local incomes, and that gap is pushing many buyers to pause or look elsewhere. When affordability breaks down, demand slows. And when demand slows in an oversupplied market, prices almost always move downward. Experts say the big question for 2026 is simple: How far will the correction go? If rent softness continues, Austin could see some of the sharpest price adjustments in the country, especially in the luxury rental and new construction segments. Austin isn't crashing, but its long stretch of explosive growth is facing a real test. Now let's move to city number 4, where another construction wave is creating some serious risks. At number 4, we move to Phoenix, Arizona, a city that has been riding a massive wave of growth, but is now staring at a serious oversupply problem. Go Banking Rates has already warned that Phoenix could face oversupply-driven price corrections, and the signals are getting louder as we head into 2026. During the pandemic boom, Phoenix became one of the fastest-growing housing markets in the country. Builders responded by launching huge projects, new subdivisions, rental communities, luxury homes, and large apartment complexes. For a while, the demand was so strong that even aggressive construction couldn't keep up. But that balance has flipped. Today, the post-boom construction surge has left Phoenix with too many homes and not enough buyers, creating what analysts describe as a building glut. Go Banking Rates points out that this oversupply is one of the biggest red flags for the city going into 2026. At the same time, demand is cooling. Higher mortgage rates have priced out many first-time buyers. Investors aren't rushing in the way they used to, and with wages in Phoenix not keeping up with rising home prices, the market is starting to feel stretched. When affordability drops and inventory rises at the same time, price corrections almost always follow. So what could the downturn look like? If conditions don't change, Phoenix could see meaningful price softening in 2026, especially in neighborhoods with heavy new construction. Some analysts warn that certain segments, particularly entry-level new builds and high-density rentals, could face mid-single-digit to low double-digit price drops. Homes may stay on the market longer, sellers could offer more concessions, and builders may start trimming prices to move inventory. Phoenix has strong long-term fundamentals, but right now the market is out of balance. Too many homes, cooling demand, and growing affordability issues make this one of the riskiest big metros to buy into in 2026. Now let's move to city number 3, a popular mountain metro where affordability is breaking down fast. At number 3, we have Denver, Colorado, a city that has been on a long hot streak, but now shows some of the clearest signs of a coming slowdown. According to a 2026 forecast from Housing Info, Denver home prices could drop around 10% in just 12 months, making it one of the most vulnerable big metros in the country. The biggest issue hitting Denver right now is affordability, or rather, the lack of it. For years, prices climbed faster than local incomes, but it's no longer just the mortgage payment holding buyers back. The total cost of ownership has exploded. HOA fees are up, insurance costs are rising, maintenance and repair expenses have jumped across the board. Housing Info notes that these extra layers of cost are pushing many would-be buyers out of the market completely. And the market is responding. Inventory has been climbing steadily, with more listings hitting the market each month. At the same time, sales are slowing, and homes are sitting on the market longer. This combination, rising supply and weakening demand, is a classic setup for a price correction. Sellers who were used to bidding wars are now dealing with fewer showings, more negotiations, and growing pressure to cut prices. Experts warn that Denver is walking into a perfect storm of challenges. High costs, elevated household debt, and the end of ultra-cheap pandemic mortgages have created real financial stress. Many buyers simply can't stretch any further, especially as everyday expenses continue to rise. The worry is that if even a small portion of homeowners decide to sell, or if the job market softens, the added inventory could accelerate the downturn. A 10% price drop isn't guaranteed, but analysts say the ingredients are all there. Denver is still a beautiful, growing city with strong long-term potential. But for 2026, the short-term risks are real. High ownership costs, rising inventory, and a shrinking buyer pool make this one of the market's experts say to approach with real caution. Now let's move to city number 2, a Gulf Coast metro facing some of the toughest economic and climate-related pressures in the country. Coming in at number 2 is New Orleans, Louisiana, a market facing some of the strongest warning signs in the entire country. Spark Rental has already highlighted New Orleans as a city at risk of steep price declines, and when you look at what's happening, it's clear why analysts are concerned. One of the biggest issues is insurance costs. Because of rising climate risks, especially hurricanes and flooding, home insurance in New Orleans has shot up dramatically. Some homeowners report premiums doubling or even tripling. When insurance becomes this expensive, it directly affects affordability. Buyers pull back, demand slows, and prices start to feel pressure. But insurance isn't the only problem. Experts say New Orleans has a weak economic foundation compared to other major cities. The local economy depends heavily on tourism, service jobs, and seasonal activity. When tourism slows down, even a little, the entire housing market feels it. That makes New Orleans far more vulnerable during times of national or global uncertainty. Another red flag is vacancy and liquidity. There are more empty homes and rentals than the market can handle right now, and fewer strong buyers stepping in to absorb the supply. Investors have also become cautious due to rising insurance and maintenance costs. When this many buyers step back at the same time, it becomes harder for sellers to find offers, and prices start sliding. So what could 2026 look like? Analysts warn that New Orleans could face double-digit price declines if these trends continue. Even in a more moderate scenario, the market could experience extended stagnation, where prices don't crash suddenly, but slowly drift downward as costs rise and demand weakens. New Orleans is a city with culture, history, and deep community roots. But from a real estate perspective, the short-term risks are piling up fast. High insurance, economic instability, climate exposure, and slowing demand make this one of the market's experts urge buyers to approach very carefully in 2026. And now we move to the number 1 city on the list, a major U.S. metro where bubble warnings are ringing louder than ever. At number 1, we arrive at Miami, Florida. The U.S. housing market experts are the most worried about going into 2026. According to the UBS Global Real Estate Bubble Index, Miami is officially ranked high risk, with warning signs that look very similar to past bubble markets right before they cooled off. Business Insider reports that Miami's metrics are now at levels that simply can't be ignored. One of the biggest red flags is Miami's price-to-rent ratio, which Business Insider points to as a clear sign of bubble-like behavior. Home prices have shot far ahead of what local rents can support. When buying becomes this much more expensive than renting, it tells analysts that prices are being held up by speculation, not fundamentals. But the costs don't stop there. Miami's climate risk is pushing the total cost of ownership to new highs. Insurance premiums have jumped dramatically, some doubling or tripling in just a few years. HOA fees have also climbed, especially in older waterfront buildings that now require expensive repairs and stricter safety standards. The New York Post has reported on these rising ownership costs, noting that many Miami homeowners are being squeezed harder than ever. Add in Miami's heavy international exposure, and the market becomes even more fragile. A large portion of Miami buyers are investors, many from overseas, and this kind of buyer base is quick to pull out when the global economy shifts. If international demand slows even slightly, Miami could see a sudden glut of listings. That's why UBS and other analysts are strongly cautioning buyers right now. They warn that Miami's mix of high valuations, rising ownership costs, and speculative buying leaves the market exposed to a sharper correction than most U.S. cities. So what's the worst-case scenario? Experts say Miami could face double-digit price declines if demand drops and insurance costs keep rising. The triggers could be anything from stricter building requirements to another jump in premiums, or simply buyers deciding the city is too expensive to justify. Miami is still a global destination with huge long-term appeal, but heading into 2026, analysts agree, this is the riskiest major housing market in America. Next, we'll bring all these trends together and break down the common themes across all 10 cities. Now that we've gone through all 10 cities, a clear pattern starts to emerge. Even though these markets are spread across the country, from the Southwest to the Gulf Coast, they're all being pushed by the same major forces, and those forces are exactly why experts warn that 2026 could be a major turning point for U.S. real estate. The first big theme is overbuilding. Cities like Austin, Phoenix, San Antonio, and Winter Haven all saw huge construction booms during the pandemic years. Builders raced to meet the sudden rise in demand. But now supply has outpaced buyers. When too many homes hit the market at once, prices weaken, even in places that used to be red hot. Next, we're seeing higher non-mortgage costs hurting affordability. Insurance premiums are rising everywhere, but they're hitting coastal and climate-sensitive cities the hardest in climbing property taxes, HOA fees, and maintenance costs. And suddenly owning a home gets a lot more expensive, even if the mortgage rate stays the same. Then there's climate risk, a growing factor for cities in Florida and Louisiana. Miami and New Orleans are prime examples, with insurance becoming a real financial barrier. When climate exposure drives up ownership costs, buyers hesitate and demand falls. Another major theme is the gap between home prices and local incomes. In cities like Denver, Austin, and Miami, prices climb far faster than wages. That creates fragile markets because buyers can only stretch so far. When affordability breaks, corrections become more likely. We also can't ignore the investor pullback happening nationwide. Many markets on this list attracted speculators and short-term investors during the boom, but investors are quick to exit when rents fall or carrying costs rise. Their exit can accelerate downturns. So why is 2026 such a crucial year? Experts say macroeconomic pressures, slowing population growth in some areas, and years of rapid appreciation are all colliding at once. It doesn't mean a nationwide crash, but it does mean the risk isn't evenly spread. Some markets will stay stable. Others, like the 10 we covered, may face real turbulence. The bottom line, this is a time for caution, not panic. Understanding the risk signals is the first step toward making smarter decisions. Now that we've broken down the riskiest markets for 2026, let's talk about something even more important: how you can protect yourself, whether you're buying a home or investing in real estate. The goal isn't to avoid every market. It's to make smarter, safer decisions in a changing landscape. The first rule is simple: focus on affordability, not hype. Many of the markets on this list became risky because prices ran far ahead of local incomes. Don't buy into a place just because it's trending or everyone says it's the next big city. Look at actual affordability, job growth, and long-term stability. Next, you should stress test your numbers. Ask yourself, what happens if prices fall 10 to 15%? Can you still make the payments? Would the property still cash flow if rents drop? Thinking ahead like this protects you from buying at the top of a cycle. Another key step is to consider the total cost of ownership. A low mortgage means nothing if insurance, HOA fees, and taxes are rising fast. This has already hurt markets like Miami and Denver. Always calculate the full monthly cost, not just the mortgage payment. Also, don't rely only on price charts or recent sales. Prices can lag behind reality. Instead, watch local economic fundamentals: job trends, population movement, inventory levels, and new construction. These indicators reveal the direction of a market long before prices react. One of the strongest strategies right now is to simply be patient. Don't be afraid to walk away if a deal feels rushed or overpriced. Timing can matter as much as location, especially when a market is turning. Lastly, consider safer alternatives. Some markets still offer stable prices, lower costs, and strong rental demand. You can also take a wait-and-see approach, hold cash, watch the trends, and strike when opportunities appear. 2026 doesn't have to be dangerous. Not if you understand the risks and stay disciplined. With the right strategy, you can avoid the worst markets and position yourself for long-term success. So here we are, the end of the list. We've covered 10 cities across the U.S. that experts say could face real trouble in 2026. From Miami and New Orleans to Denver, Phoenix, Austin, and the Florida boomtowns, the story is shockingly similar. Too much building, cooling demand, rising insurance, stretched buyers, and price levels that simply don't match local incomes. Are you surprised by any of these cities? Where do you think the biggest real estate crash could happen? Drop your answer in the comments. And don't forget to hit